Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. Jeremy Dyer here, VP of Capital Formation with Rise48 Equity. I'd like to introduce everybody that's here today to Inside the Deal. We're going to be talking specifically about Rise48's approach to underwriting. And I'm going to be joined here now by Casey Chandra, our VP of Investment Management, who's going to take over from here and walk through our methodology. And then towards the end, we'll open it up for, again, a live Q&A session. All right, Casey, I'll go ahead and turn it over to you.
Thanks, Jeremy. Definitely happy to be here today to talk about our underwriting approach and kind of shed some color on our philosophy as well as the broader market and kind of help everyone do their due diligence when selecting a sponsor, a deal to invest in, and hopefully kind of our underwriting philosophy stands out. So with that in mind, I'll get started. Why does underwriting matter? Obviously, with everybody in the room, everybody's end goal is to make money, right? So with Rise48's philosophy and our financial targets in mind for our specific LPs, we want to make sure whether a deal aligns with our targets and investor return goals. So typically that means we underwrite to a 2x equity multiple to make it worthwhile for the investor and the sponsor, such as ourselves. We want to protect investor capital with the levels of underwriting that we have. And then obviously with Rise48's astronomical growth in the last couple of years and looking at our forward trajectory, we want to make sure to preserve the portfolio integrity and performance as we continue to underwrite at an aggressive pace. So kind of with that, going into our underwriting philosophy, deal flow and market coverage. The slide's pretty much like it sounds. We have broker relationships throughout the country. Right now, we're focusing on Phoenix, Dallas, Fort Worth, Charlotte, Greensboro, Raleigh, kind of the triangle and the triad there. And then we're also actively looking in Tennessee, Orlando, South Carolina, Tampa. We're aggressively looking in. But the main focus of all of the deals that we're looking at underwriting the different MSAs is to diversify the risk profile of our portfolio. Right now we are concentrated in Phoenix, and we're starting to have a better presence in Dallas and especially in the Charlotte, North Carolina area. And as we kind of stand up those two other MSAs, we want to make sure that we are actively looking to diversify our risk profile again. So we get literally hundreds of deals every 2 or 3 days in our emails, and me and my team are actively underwriting and looking to make sure that we're achieving the initial quality metrics in order to go to a level 1 underwrite. And so kind of leading into the next slide there, Jeremy.
Yeah, and I was just going to highlight just one quick thing, Casey, just so people understand if they don't already know this. And that is, in the markets that we operate in, about 90% of the transaction volume is largely controlled by just a few main broker groups, right? So having a strong, presence and a strong relationship, with those commercial real estate brokers in those markets, right, is paramount to us as an operator being able to see, the type of deal flow, that we're predominantly looking for. Just as an example, our founder and CEO, Zach Haptonstall, is in Dallas this week. And then next week, I believe all of next week, Zach is actually going to be in Florida, specifically in Tampa and Orlando, meeting with the local brokers, in that market, because that is a very that those two markets are markets that we've been trying to get into, now for about the last 12 to even upwards of 18 months. And so Zach going out there and meeting with those local commercial real estate brokers, again, is paramount for us as an operator to be able to get access to the deal flow in those two markets that, again, we're looking to expand into here in the next year or so.
About 30% of the deal flow we get with our brokers is off market. So we've established these relationships and we're getting first look at a lot of these properties before they even hit the market. So whether it's a lender that's going to foreclose on another owner operator and want us to take over the deal because we have a historical track record of performing to our business plan, et cetera. Like 90 to 95% of the deals are sourced through brokers, but then 30% of that 90% is off market, just to give you a level of the viability that we have within the real estate community. But today I'll kind of talk high level about the 3-level process that we have. Level 1 is our market screening. We use qualitative and micro market filters in order to assess and determine whether or not we want to move to a level 2. So we have, on-site verifications, pass-fail logics with glaring red flags. And then the main thing with level 1 is alignment with the investment scope, which I'll talk about in the next couple slides. Level 2 is our financial underwriting, which is our quantitative steps, right? We want to fully underwrite the deal to make sure we can support our maximum support case. And then for level 3, it'd be the validation and verification. So we want to shop comps. We want to make sure the operations staff that is going to be running the property and the regionals touch the property, walk the property, and determine if a pool is going to need resurfacing that we can't see from, behind the screens here at the desk. So kind of with that in mind, the 3 different levels, one definite thing to keep in mind is, again, only 3 to 5% of all opportunities do pass all 3 levels. And just to give you an idea, since Rise48's been tracking this, I think we've underwritten about 2,000 deals, and we have about a 2 to 3% strike rate on those deals that actually pass all 3 levels.
Yeah, that makes sense.
So
Casey, can you provide us like that kind of top-down funnel, approach when it comes to level 1? Like I would assume level 1 is the lion's share of the deals that drop don't even make it past that level. And how do we as a firm, or how would a best-in-class operator in that lens, how would they eliminate these brokers from sending them deals that really aren't really in our buy box, if that makes sense?
Yeah, no, that's a great question, Jeremy. And that's a lot of the questions that we get from brokers as well. So we have an initial qualitative filter, right? We focus on anything that's 1980s vintage or newer, 100 units plus, just to make sure that value add business case that we operate on and that we execute really well on is going to come to fruition to hit that 2x equity multiple. And then we also make sure that it's not going to be in any type of like industrial areas. It's going to be in an area that's well populated, high job growth markets. We look at household median income, crime level, school proximity, parks, amenities. Zoning is becoming a big one recently. And then obviously like the environmental negatives, like is there a gas station down the block from the apartment building that might have some kind of environmental, where we would have to do a phase 2 environmental study to determine if there's any leaks underground that we would have to potentially address later. And so the entire purpose of that level 1, again, is like we begin with a defensible opportunity supported by strong fundamentals rather than attempting to underwrite around a location risk. And that's really where our kind of qualitative funnel starts to eliminate a lot of the opportunities that are presented to us to make sure that we can fully own and operate it according to our plan. And I kind of just touched on this earlier with the funnel, right? The biggest things is median income, crime stats. Google reviews is a big one for us, believe it or not. Like the seller's going to position themselves at the strongest position possible, but Google doesn't lie. So if you sort the reviews, we read through them just to make sure that the rents that we are underwriting and that we want to achieve are going to be, realized, so to speak, after we do our value add proposition. The income to rent analysis, that's a hard stop. We make sure to minimum qualify the 3x rent to income rule because of the demographic and the workforce housing that we are marketing to with this value add proposition. And then obviously with the early elimination, we disqualify the deals. Again, where pricing exceeds nearby home values, which is a huge thing, or where rent growth is too constrained. Obviously, in this macroeconomic environment with some of these markets, rent growth has been a little constrained with the absorption of all of this new supply that's come online. But in the past kind of 12 to 14 months and looking forward, we anticipate the absorption to increase dramatically. And the new supply coming online is almost next to nothing because of that boom that's been happening. So any questions around the level 1 before I kind of move on to level 2?
Yeah, I was just going to mention one question, and that is, have we been exploring or utilizing any AI tools, for our initial market screening process at level one?
Yeah, I mean, we have our own bespoke kind of ChatGPT agent that we also use. We load all of our underwriting criteria, our models, our portfolio, financial metrics, everything in there to make sure that we're looking at the MSA specifically. But then there's other AI tools out there that we use. We're evaluating a software called Archer. Red IQ is out there. There's a whole bunch of stuff that's out there, but for Rise 48's value add purpose and then the qualitative nature, we are designing our own kind of AI agent, so to speak. And my team is very hands on with that. And we not only look at like what the underwrite looks like, but we also look at what our assets have been performing like after we've acquired them in an asset, and we marry all of that into our initial kind of underwriting box, which again, we're training our AI agent to do.
Yeah, I would suspect that because we have 50 deals currently under management, today, in the three or four major markets that we're in, we can use our own qualitative, data from our own already owned properties, in those markets as well. So we'll go ahead and move on to level two here, Casey.
Yeah. So level two, our financial underwrite, it's pretty standard, I guess, from what you would call from an industry. But what drives us, differently from other operators is we look at the physical walk and the qualitative review, and then we tighten our assumptions kind of back to what our detailed modeling looks at. So we intentionally push our underwriting to the highest end of what the market can support, but not beyond it. So it's not meant to inflate returns or anything like that. It's just to look at whether the deal has the capacity to realize that maximum investor threshold. So, for an example, if market rent is $1.90 per square foot, the model first tests the deal at $1.90 to understand like that theoretical maximum performance. Or if payroll in comparable properties is called, $1,700 a unit per year, that assumption is plugged in initially. And then we kind of dial it in and fine tune it based on what our ops team says and what we're experiencing in our own portfolio based on that specific MSA. And then we also, screen whether the deal has just enough potential to justify the detailed evaluation and a field walk after it kind of passes our level two initial pencil. From a capital structure perspective, we typically look at, a bridge product, a 3-1-1, just given the market and the way it is currently. Obviously, with rates coming down, we are assessing other products. The reason we look at a bridge product for this particular type of business plan is with Fannie and Freddie, there's such thing as yield maintenance or defeasance, which we are hit pretty heavily with prepayment penalties. But again, when we look at the different products that we offer, we do now take into account the risk profile of the market. So it might be better for us to enter into a longer tenor Freddie or Fannie and pay that prepayment penalty and recognize a investment return that's a little bit lower than the 2x we would have initially underwrote versus a higher risk 3-1-1, just given, again, the macroeconomic environment and kind of the way everything's shaking out with our business plan execution. I think, yeah, and again, just the writing on the page there, roughly 50% of level one deals do fail here due to unrealistic pricing or insufficient yield. Insufficient yield just meaning ROI. We want our investors to be confident in the return that they're going to get. And even if it pencils to a 1.2 or a 1.4x, that's not good enough from our end because we want to be able to be confident to execute our business plan to the best of our abilities under a conservative underwriting model. I'll kind of pause there with any questions.
Yeah, that makes total sense, and I appreciate that. Casey, would there be a time during an acquisition where it maybe makes more sense to review the T3 or the T1, as opposed to just pulling, all of your data, from the seller's T12?
Yeah, so we underwrite going in mainly on a T3 income and T12 operating expense basis, because what a T3 does is it allows us to look at what the most recent performance of the asset has been. So if a seller, had been struggling to lease it up and then they were able to renovate some units or they were able to market it differently and get more high quality tenants in there, obviously occupancy is going to ramp up. And so we base it based more on a T3 income basis, but we do look at a T12 OPEX basis just because, we want to make sure that the seller's not trying to pull any funny business or move things around to make the T3 NOI look good. So we look at the full T12. But then we do take into account, one-time events that have occurred with the seller or just other things in general. One thing that we do not do is buy operationally distressed properties where that might look good from our value add execution perspective. The amount of capital and time that would take to essentially release a property for being operationally distressed from a 60 to 65% occupancy into that 85, 90, 95%. Is way more capital intensive and timeline intense than we would like. So we shy away from those deals just because, again, we want to make sure we're operating to our maximum capacity.
Yeah, I'm glad that you highlighted the operational distress thing because there are operators that will intentionally look for deals that have operational distress because they can, usually pick them up at a discount. But that's not really Rise's approach or strategy is to go find a deal that's maybe, struggling to hit 60%, occupancy because we know that the lease up time period would take a tremendous, long time, to pull that property back up. So appreciate you highlighting that. All right, now we're going to move on, Casey, to level 3. What can you tell us here?
Yeah, so level 3 is really kind of where the rubber meets the road, so to speak. We engage our insurance brokers, tax consultants. I mean, you can read what's on the slide there. But essentially what we're looking for is validation from other OPEX assumptions, right? If a seller has extremely high insurance expenses, we know that we're going to get synergies by putting it under our policy. So we'll reach out to our insurance broker, with Texas or Arizona being big ones. Our insurance expenses with the type of policy we have typically in Texas come in lower than most sellers have operated them at. In North Carolina, we engage tax consultants. We have a great partnership with Saha where we enroll in a tax abatement program, which has come to light in the kind of last 12 months to us in the way we underwrite. It's a government approved program. There's no loopholes or anything like that where the Texas property tax litigation is kind of like a loophole in that area. But we make sure that we engage third party bids to get accurate CapEx quotes for exterior paint, pool, dog park. If we're going to underwrite to our platinum level finish, we want to make sure that the GC that we're going to use in that specific MSA can verify that that is the cost that's going to be associated with renovating the unit to get that rent bump and ROI on that CapEx that we're going to spend. Asset management, which falls under me and my team as well. They physically shop the comps. They're calling. They're looking at all the specials and concessions that they're offering, and we bring that back in and we stress test and underwrite to be like, okay, if there does happen to be some new supply coming online a mile down the road in 9 months and they're going to operate at 8 weeks free, we take that into account, kind of maybe back off organic rent growth from where CoStar might have projected, or things like that, just to make sure that we look at the real viability of the project versus just, again, looking at numbers on a spreadsheet. And then again, CapEx budgeting all in for interior and exterior, about $25,000 to $30,000 a door, including amenities and then deferred maintenance. Deferred maintenance includes things like ventral chillers, HVAC, electrical units, that type of thing. So
yeah, makes sense. Yeah, and I'm glad that you highlighted the concessions and kind of what our on-site, team does to walk, the competitive assets. Because really at the end of the day, in any sub-market, right, our post-renovated product, right, needs to be able to compete with our competitors in that local sub-market, right? And so it's important, for our on-site team, to be secretly shopping, those competitive assets in that market, assets that have similar, interior finishes, similar square feet, right? the vintage is, similar or comparable at the end of the day. And one thing that's really important, as well is kind of, once we get to level three, and you can, correct me if I'm wrong here, Casey, but, really what we're looking to achieve is, can we stay from a price per square foot, post renovations, can we stay at or even slightly below in some cases, post renovation cost per square foot when compared to our other comps, in that local submarket? Does that make sense?
Yeah, no, absolutely. And when we do that, we make sure that we're doing like for like, Jeremy, as you kind of stated, right? So we're not going to go shop a Class A comp. We recognize that that might be coming online down the road about a mile, mile and a half, whatever the case may be, but we will shop like for like Class B comps to make sure that we're able to stay within that risk threshold. And again, if we feel like there's too much risk, with other supplier, other competition, or the job market, whatever the case may be. Even at level three, we've killed so many deals where we're just like, we're not confident in the fact with CoStar's construction pipeline report and everything coming online that we're going to be able to execute on our business plan and get that investor return at the end of the day. We'll kill the deal even after we've gone through all of that, just because again, risk profile, and, kind of investor capital and return conservation is our number one priority.
Yeah, absolutely. And I think it's important to highlight, that we, even after level three, we've walked away from deals that on paper, really penciled and they looked good. Most recently, there was a property, I think, in Dallas that, passed level three, and we sent our local on-site team out there to tour the property, on the exteriors and some of the interiors, and it wasn't right. It didn't feel right. The population that was living in that community, what I think have been fairly difficult, to manage, from a resident retention perspective. And there's been other properties, like we had a deal down in Dallas. I remember last year, another solid deal in Dallas, but, we found out, at the kind of in the bottom of the ninth inning, that the seller tried to slip in some language into the buy-sell agreement that had to do with the potential of the city or county taking a couple of buildings offline due to eminent domain because they wanted to expand a highway, right? Well, that was not disclosed, to Rise on the front end, so because of our additional due diligence process that we go through, at really all levels of the underwriting process, we were able to, of course, identify that, reach out to the Texas Transportation Department, and they disclosed to us that they had told the seller, I think 6 or 9 months earlier, of that eminent domain potential, but it was just not disclosed to us on the front end. So you can only imagine, an operator takes possession, of a multifamily apartment community, and maybe there's, 10 buildings, and the government is going to take 2 of those buildings offline in the next 2 years. It's going to be tough to produce, that 2x equity multiple. So I think it's just really important, everybody, to understand that, there's not necessarily equality as it relates to the way in which operators underwrite deals. People oftentimes will use that word conservative. I don't like the word conservative when it comes to, investing my own dollars, into these types of opportunities. Instead, I'd rather use the word realistic, right? Because that's really what we're looking for, is what are the realistic, outcomes here, and why is our underwriting realistic as opposed to being, just conservative in nature. So now, Casey, we'll go ahead and turn it over to our deal stats, which I think you might have covered a little bit of this, but if you want to go ahead and finish up here, we'll keep moving through the presentation.
Yeah, of course. Again, the slide kind of speaks for itself, but just high level since 2022, 1,000 deals, 30 deals that worked in our model, and then almost 3% of properties that actually worked that we made an offer on, not closed on, that we made an offer on. And then the average offer, obviously, compared to the seller's asking price is about a 15% discount. And so, to this point, only deals that perform defensively under multiple stress tests make it to acquisition and investor offerings and investment committee. Otherwise, we'll kill the deal in the beginning. Zach and Bikram may not even see a deal, just because we've killed it, and we're not going to bring it to them if it's even close to being not viable. And then I think we talked about this a little bit earlier on in the presentation, but again, we target loan to value anywhere from 60 to 75, just depending on the vintage of the asset, the lender. Obviously, the higher the leverage, the increased risk. So that's why, again, it's important for the deal to pencil under multiple stress tests. So that way, when we are building our capital stack with our equity base and our investors, we're able to conservatively get a 60% LTV versus a 75% LTV or something like that to make sure that the returns are protected. Debt yield, we aim for in-place debt yield around, again, 8 to 8.5%. Lately, we've been underwriting to a little bit higher of a 9, just again to focus on that risk profile and risk parameters. And then the bridge loan, obviously, the 311. We don't want to raise all the capital up front for the CapEx because that would just increase our equity ask and our long-term interest rate exposure. So we do the future CapEx draws where we do the value add, and then we go to the bank and we ask them to reimburse us for the spend. And at that point in time, we start paying interest on that money, and it's not from day zero. So that's kind of just this slide in a nutshell.
Yeah, it makes sense. And I'm going to make a comment on that bridge loan, strategy relative to the CapEx, and then I want to ask you to unpack the debt yield a little bit more, just for those that aren't familiar, with what debt yield is. But the main reason why we don't raise those CapEx dollars on the front end, and those CapEx dollars are actually funded directly from the bank, is because if we raised, say, $4 to $6 million in CapEx up front, right, for future renovations, we would have to start earning a pref on that raise. We would have to solve for a 16% IRR on those CapEx dollars that we raised on the front end that we might not spend until years 2, years 3, or in some cases, if ever, right? There's actually never been a single deal, I think, Casey, where we've actually spent 100% of the CapEx budget. We've always spent, something less than, what we originally, underwrote. And so if you have any comments on what I just said, please do address that. But I also would like you to unpack for, those that aren't familiar, with what the debt yield is and why that's an important, metric.
Yeah, of course. Thanks, Jeremy. So a super simple, plain English. A debt yield basically tells the lender how much cash flow a property produces compared to the amount of the loan without factoring in interest rate, amortization, or loan term. So it kind of answers the question, if the lender had to take over the property tomorrow, how much return would they earn on the loan amount based on today's NOI? And so why do lenders care about that? It tells them how safe their loan is, how much cushion the property has, and then whether the property can support the debt even in tough times, so to speak. A higher debt yield is a safer deal for the lender. A lower debt yield is riskier because the property is potentially producing less NOI relative to the loan size that's been issued. So I can expand on that if you'd like, but that's a pretty decent explanation around debt yield.
Yeah, no problem. Well, if there's any questions on that, we can get those towards the end here. So we'll move on to risk management.
Yeah, so risk management and underwriting is kind of like our level 4, so to speak, right? It's our defensive modeling and stress testing, kind of like we talked about earlier. They're the conservative final assumptions. After the maximum amount case, we always pair back to conservative reality-based numbers. Every controllable assumption is supported by CoStar, RealPage, market research, or our own AUM or historical performance. We evaluate worst case scenarios like 0% rent growth, exit cap rate expansion beyond expectations, and then obviously the concessions remaining elevated. And then we also, again, kind of buffer for that uncertainty with things that I've talked about. We have full investor transparency. So the stress tests are presented to the investors to not only show the base case, but the downside scenarios as well, which are shown in all of our decks in the sensitivity tables. And then we also provide the full underwriting model so everybody can do their own due diligence as far as cap rate compression or expansion and kind of play with the return assumptions on that end. And at the end of the day, we focus on controllable NOI. And so that's why the cross-department review is super important. When we are standing up our asset management plans and our execution, we have sign off from Zach, our CEO, Bikram, our CFO, Kaylee and Dana, who are co-presidents of operations. and then obviously myself and my investment manager, just to make sure there are multiple eyes and ears on making sure that the business plan is going to be value accretive and it's executable before we issue an LOI. All of this happens before we issue an LOI. And so, sorry, I just kind of lost my train of thought there. But at the end of the day, we just make sure that we are always check and balancing to make sure that we can potentially account for some kind of macroeconomic factor. Obviously 21, 22 was unprecedented, but we want to make sure that we mitigate towards that moving forward. So
yeah, it makes total sense. And guys, when I talk to investors, and some of you have heard me talk about this before, but I as an investor want to mitigate three things when it comes to risks. One is operational risk, two is execution of the said business plan risk, and number three is market risk, right? And so really here you've kind of got, these risk management tools built into the underwriting of my main three, risk factors that I try to mitigate against myself, as an investor, and how I try to articulate, that to my investor network as well. The third of those risk factors is that market risk, right? Those are the things that are largely, uncontrollable, things like organic rent growth, the impact of tariffs, higher interest rates for longer, exit cap rates, right? A lot of those things we use because we have to model it out, in a what if case scenario, right? But it really comes down to, how realistic, right, are some of those assumptions, relative to things like organic rent growth, exit cap rates and those types of things. So anything else that you'd like to add there, Casey?
No, I can't stress enough that we definitely, we mitigate our risk as much as we can. And I wouldn't be surprised kind of moving into the next 12 to 24 months that our strike rate, becomes a little bit lower. It might be below 2% just because we are being very realistic, Jeremy, to use your verbiage, to make sure that we're underwriting the best deals possible for not only our investors, but for Rise48 as a company, and to ensure kind of longevity moving forward.
Yep, makes sense. All right, insurance and market selection.
So for this, essentially, we just want to make sure the slide kind of speaks for itself, where Phoenix, Charlotte, Dallas, Fort Worth, they have strong fundamentals, strong job growth, lower insurance risk. Obviously, kind of moving into Florida a little bit, we have to be cognizant a little bit of that. But we just want to make sure that our insurance per unit that we underwrite stays in line with the specific MSAs. Obviously, you're noticing in Texas it's significantly higher, and that's just standard kind of across that MSA on its own. But we always work with our brokers to make sure that we are spreading the risk across our entire policy, so that way we're not risk concentrated in one specific MSA, the way our insurance product is structured. So nothing really to expand on this slide here.
Sounds good. And I think the insurance costs have been trending downward in Florida lately because thankfully
Yes.
there was no hurricanes this year.
Yes. Yeah.
Major ones. All right. So let's talk about those lessons from 2022 through 2024.
Yeah, absolutely. And that's kind of been a theme as I've discussed our underwriting. The biggest thing for us, obviously, the lesson is rising interest rates. Obviously, with the rate hikes and the bridge loan structures and the cash flow margins, as that box says, we are very, very cognizant of interest rate exposure. So obviously, with our bridge products, we buy an interest rate cap, effectively fixing our interest rate interest rate. And then more recently, with kind of rates starting to trend down, we've been looking at floor hedges. So we'll buy the floor. So what that means is if there is a minimum interest rate defined in our loan document, we will actually buy the floor out. So that way it's not affected. So if the interest rate drops below whatever the minimum threshold is in the loan document, we actually benefit from that too, just like an interest rate cap would. So we're hedging our position between a max and a min based on where we think the market is going to go. And right now, interest rate floors are very, very inexpensive for us to buy those with our newer deals kind of moving forward. Obviously, with Rise48 operations and learning to make sure that we have proper interest rate cap reserves and then cash flow reserves, while ensuring that the investors, preferred equity and the returns and distributions are consistently being met. We're making sure to evaluate, again, stress testing at 60% occupancy. Worst case scenario, are we still going to be able to maintain operational efficiencies and continue distributions without risking potential capital call or anything like that in the world. But investor focus is, again, our number one priority, and that's where our underwriting has really, really concentrated and shifted. It's always been there, but more so, especially conservatively and realistically in the last kind of 6 to 8 months.
Makes sense. And hopefully people understand, why we continue to leverage, a bridge, product as opposed to, a 5-year agency, Fannie Freddie, type of a loan, is because we're a transactions-based operator, and you get hit with a nasty, prepayment or yield maintenance defeasance, in the event that you decide to transact or sell, the deal, before that 5-year, loan maturity. So for us, it's maximum flexibility is really what it comes down to. And then we mitigate, against some of that exposure by raising additional funds on the front end in order to be able to extend out, that loan, into years 4 and years 5, and/or, we've built up enough, net operating income and the DSCR, or debt service coverage ratio, is healthy enough in order to be able to, also potentially refinance, into a longer, debt term product or instrument, after that 36-month period. Does that make sense, Casey?
One of the biggest things for Rise48 is that we are vertically integrated. So obviously Rise48 Equity is what you see, but then we also have Rise48 Communities and Rise48 Residential, which operate our communities. So we're all in-house property management. The property management fees that the properties pay go directly to that overhead and kind of like Rise48 Group to sustain payroll and all of our overhead expenses. And then obviously with Rise48 Construction, we have that in-house as well. So when we're doing our CapEx projects, we also benefit from the construction management fee that's underwritten into our models. Obviously the bank is paying for that. The investors are not paying for that at all. The bank is paying for that, and we have that built into our underwriting and our CapEx draws. And then just Rise48 as a whole, again, we control everything in-house. So if we think that a property isn't leasing fast enough or leasing well enough, we make that call to pull that property manager and put somebody else in, or whatever the case may be, to make sure that the property operates where we need it to be. And then from an independent standpoint, yes, we could probably go half a year without buying a deal or a full year without buying a deal, and we can operate profitably without the acquisition fees to put into our corporate reserves, in order for us to make sure that we're operating everything efficiently. So, if we do end up buying 12 properties next year, our goal, hopefully is a deal a month, we can scale back and say, okay, we have to make sure that we're operating these to the best of our ability. We're not just going to continue chasing acquisitions. So that kind of sums this slide up.
Yeah, that makes total sense. And one of the things that, for those that don't know, I wrote a book called The Fundamental Investor, and there's one major thing that I feel like I left out of that book that I should have put in there. And that is as it relates to the sponsor's ability to lead an organization, leadership and their qualities to cast a vision, create a culture, inspire best-in-class talent, to come work for them. There's also been a couple of folks that, or I think a good amount of you have actually been on our market tours before, whether that's the one that we hosted in Phoenix, a few weeks ago, the one that I hosted out in Dallas, or the one that I hosted, out in Charlotte, or Nick and I did. One of the things that I always ask our local on-site, maintenance technicians, property managers, community managers, is, were you working here before Rise48 took over ownership of the property? And the answer is almost always no. Okay. What that effectively means is when Rise takes over the ownership of an asset, if the local on-site team that's leading that asset or is in charge of that property, at the time that we take over ownership, is not bought into our vision, our culture, and everything that we stand for, right? We're going to replace those individuals with best in class talent that we've sourced within. And when you're, as large as Rise is, now having, I think, over 350, full-time W-2'd, employees on benefits, it really puts us in a position of strength. But how we get there and how we got there is really largely predicated on the fact that we have top-down leadership within our organization that really challenges everybody at all levels within our organization, to really bring their A game, every single day, day in and day out, whether you're the maintenance technician or you work at the corporate, headquarters, right? It's very much a work hard, play hard, type mentality. But at the end of the day, we're here to serve two people. Number one, we're here to serve our residents. And number two, we're here to serve our investors, right? And so as long as we don't lose sight of the two most important people, involved in the equation, and that we stay laser focused on serving them, that's what enables Rise 48 to continue to break down, barriers that, quite frankly, not a lot of other operators in the space can do. All right, Casey, you want to hit this one up, and then I think we're transitioning.
Yeah, I think I touched on this in the last slide, but again, we expect to acquire 10 to 12 deals per year, but keep in mind, in order to acquire that 10 to 12 deals per year, compensating for about a 2% strike rate, we're underwriting 200 to 300 deals. We're probably underwriting more than that, but just so you guys are aware on that. And my team does not like me when I'm pushing everything through the pipeline, but with our enhanced underwriting standards, obviously increased reserves in the money interest rate caps, and then more conservative projections. I'll strike conservative and use realistic, like Jeremy said. One thing that we are enhancing is, we recognize Class A and Class C, like as the market progresses and kind of the economy scales, they are becoming a much bigger factor, more Class A than anything. So we intentionally underwrite rents below Class A by a meaningful spread. Rents are not materially above Class C unless the renovation scope justifies it. And the renovation premiums stay within that affordability brand. So we want to make sure, obviously, that somebody that could live in a Class A wants to come to live in a Class B because of our renovation scope, the quality of finishes, the amenities, and then obviously they can save $500, $600 a month by moving into our property versus a Class A building. We never underwrite rents in isolation. So it's just more of like, is Class A discounted enough that it becomes a substitute, versus kind of like a real comp, so to speak. That's become more prevalent in the last 12 to 14 months, as absorption increases. And then obviously as it tails off. So I just wanted to make sure to touch on that. And then long-term vision, we've kind of talked about throughout this presentation, but.
Yep. Sounds good.
All right. We had some awesome questions. So Casey, are you okay hanging a little past the top of the hour?
Yeah, of course.
Okay, great. So one of the first questions was just, when you think about our deals coming off market, does that really matter in this current season when there's not a lot of buyers? How does the off-market deals work? And maybe even just an example of what was one of the example last off-market deals that we acquired.
Yeah, no, that's a great question. And I can definitely understand the premise behind that. So for us, a lot of our off-market deals right now are coming from lender relationships. They're foreclosing on a lot of these owner-operators that just can't sustain or whatever the case may be. So a lot of the off-market deal flow that used to come from broker-dealers, that's still about 10% of the 30% of off-market. But now it's more of our preferred lenders that we work with are coming to us, be like, hey, like, we know you guys are executing well. We have no problems with you. Can you look at buying this property? And often we'll get it for a substantial value. And they've already owned or operated or foreclosed on it for a year and put it through its paces. So it's not a distressed property when we take over from that lender. One of the biggest examples would be Rise Chapel Hill, the last one that we just closed on. Off-market deal. It was a lender foreclosed on for about a year. They operated it. They put about, I think like $2.5 million in CapEx into it just to get it back to baseline, where we were okay to come in and say, okay, now this fits our value add strategy. We'll go ahead and purchase it from you. And in doing that, not only do we get a great value, we also get favorable loan terms, a little bit more flexibility here and there. So off-market deal flow just has a different pulse to it for us in the last, probably 6 to 9 months than it has historically. So very
That's
much.
awesome. And I've heard the next 12 to 18 months feels like maybe one of the best buying cycles that we've seen in a while. Casey, could you speak to why that is and what we're anticipating for deal flow coming up?
Yeah. So obviously, with 21, 22, a lot of those deals that are purchased under bridge term, that could be under distress. A lot of that is coming to maturity. There's a lot of lenders that are reaching out to us, like us specifically using Rise 48, that are saying, hey, like, we're getting ready to foreclose on this deal. Will you take a look at it in this MSA, whatever the case may be? So, you know, given the macro environment as well, with interest rates starting to come down and hopefully, the multifamily sector seeing the quantifiable impacts of that because it was a little bit slower moving than commercial or industrial, in the future 6 to 8 months with cap rate compression coming down, cheaper debt, it becomes, just a place for us to deploy all of the dry powder that we're fortunate to be able to raise and have for investor returns.
Yeah, awesome. Matt asked a good question. Matt, excited to talk to you here in a few minutes. He was asking about stress testing concessions as new units come online. How does that? How do we think through that? And what happens? Years 2 to 5 are at near exit. How do we calculate that into our underwriting?
Yeah, man, that's a great question. So I think that goes back to us just making sure to shop comps and then getting reliable um, pipeline data, not only from CoStar, but from our broker relationships, whatever the case may be. And we won't just shop like our class B comp, so to speak. We'll go shop class A, class C, whatever the case may be that's going to be in that immediate vicinity, that could potentially cannibalize our rent growth or whatever the case may be. So we have risk parameters in our underwriting profile where we can be like, okay, well, our recurring concession, our economic vacancy is going to be 10%, 12%, 14%. What does that do to our debt yield and our overall investor return risk profile? And is this realistically going to have to be longer than a 5 year hold period as we come to that tail end? So, I mean, it's a very broad stroke, but we look at all those sensitivities and we have a parameter that says, okay, if it dips below even like a 1.6, 1.7, given a 20% EV, it's not going to work. Like we can't risk that. We're not going to put ourselves at risk or investor capital at risk to do that. So we're going to pass on it. So we are, and we're also re-engineering our underwriting model, kind of like Bikram said, with our software that's going to be able to allow us to scrape more real-time data as we go through our turns and phases of underwriting.
Thanks. That was awesome. Can you walk us through how we set exit cap rates? We typically supply a sensitivity analysis. How do we kind of set the low and the high and kind of where we end up for our exit cap rates?
Yeah. So obviously CoStar is a primary source of data, but then we are also actively talking to our brokers who are giving us sales comps kind of on the back end through their internal data sources. So like John Chang is a great one. We have multiple relationships everywhere, but they're giving us kind of like the layer beneath CoStar to allow us to look at what true cap rate trades have been, and then we sensitize it from there. Obviously, we sensitize it to, half percentage point, whatever the case may be, but we make sure that we are underwriting to, like a realistic cap rate. Obviously, we want cap rate compression and we'll underwrite that, but we also try to make sure that we look at if a cap rate is staying flat, or potential expansion, that the investor return profile kind of stays the same. So.
I was just going to mention just one real quick thing related to that. Within our underwriting model, we've built out those sensitivities where we allow, capital raisers as well as investors, to play around with our organic rent growth assumptions as well as our exit cap assumptions as well. So within our underwriting model, you can actually play around with different scenarios based upon what maybe you believe the exit cap rate, is going to be, in 3 to 5 years from now, as an example, or maybe what you feel is more aggressive or more conservative, as it relates to, years 1 through 5, organic rent growth assumptions and so forth. So that's one of the things that I really like, about the way in which Rise underwrites deals is we actually allow investors and fund manager partners to play around with those sensitivities, as well on their end.
That's great. Sandra asked a good question about how do we make sure that the income that sellers are saying isn't artificially inflated on the T3? How do we make sure we're not getting fooled? What's our process to really dive into the data?
Yeah, great question. So Sanjay, I think you're asking more around if sellers are floating occupancy, which is a concern. But so we ask for a full AR, AP. We look at everything from a rent roll basis. We also try to do cash proofs to make sure that obviously the income reported matches what's going on. We ask for balance sheet. We ask for everything in due diligence to make sure that we're underwriting true like T3 and not inflated. And if we think the seller's overstating it or there's something funky going on, we'll discount it. We're not going to take it for face value, or we'll push back on the broker to be like, hey, what's going on? What's going on here? I come from like a true M&A private equity background. So that's definitely something that we take a very close look at.
And how many times have we had to go back to a broker and say these numbers aren't correct, or even walk away from a deal because of getting inaccurate information?
Yeah, honestly, in the last quarter, we've done that 4 times. Specifically, there was one deal where they had been floating occupancy, and it took us almost 30 days for us to get an AR report from them. And it turned out that they had almost $45,000 in AR. So, yeah, our level of due diligence is pretty detailed to make sure that stuff doesn't slip by.
Awesome. All right, Mitch asked a slew of questions, so glad you stayed on here, Mitch, to get them all answered. So when we get estimates in the underwriting model, how do we know which things are estimates versus firm quotes as we're moving forward with a deal?
And Mitch, let me clarify. Are you looking for like CapEx, or kind of what are we?
Yeah, just try to figure out like when you guys move forward or like are moving forward with a deal, like what numbers in your underwriting are firm and like which ones are still estimates.
Sure. Great question. So the only ones that would potentially be estimates is our CapEx. We get bids, rough bids from third-party vendors, but we put a placeholder in just because in order for us to close on the property and everything, we need to make sure to build the investor deck and get to investors. So we want to show them a CapEx number, but the real like firmed up CapEx numbers come after we've selected a lender, and we submit true CapEx schedules. And moving forward kind of into the next quarter, we're going to be releasing what are called AMPs, or asset management plans, that'll have a full concrete breakout of the CapEx allocation and dollars after we close on the property of where we're going to spend and execute, just to give, again, that much better level of transparency. But for our our presentations and decks and everything, we have within a 5% number of what our CapEx is going to be.
Awesome. Thank you for that. Okay, continuing on with Mitch's next question. When we think about going full cycle on a deal and thinking about when we're going to divest an asset, how do we know when that should be? And what's our what are we aiming at in terms of getting for a return profile for our investors before we would start to consider disposing of an asset?
Yeah, so that also falls on my team as VP of investments. Basically, my team is doing everything is doing everything outside of talking to the broker themselves. We have Brady and Harrison, who are our director of acquisitions. They're the relationship guys, but then everything else is on my team. So we're doing underwriting, acquisitions, asset management, and dispositions. And so right now we're evaluating about every quarter. Obviously, with the market starting to shift, we're looking at it a little bit closer. But we look at kind of like what our forward 12 NOI is going to be looking like, what our trends are, and what that cap rate sensitivity looks like. Our goal at the end of the day is to get the investor return to as close as the 2x that we underwrote. But obviously, I don't think anybody's going to balk if we say, hey, this is a really good time to sell the asset. We're going to get you a 1.5 plus your 20% annualized, return on cash. Plus, we're going to catch up all your pref. So we're constantly evaluating it as my team gets ramped up even more so. Especially kind of going into 2026, we're evaluating those constantly, especially on some of these older deals.
That's great. Double clicking into due diligence. Besides the Rise 48 team, third party contractors, do we have professional inspectors also inspect all properties? What does that process look like?
Yeah. So every property that we acquire we engage BBG, or whoever the lender wants if it's not BBG. So they do their full report. We have Alta surveys, zoning reports, environmentals, all of that. And that's all available to our investors, to you guys as fund managers. We load it up into a data room, and it's all available for you to look at. So we do that every single time. And then additionally, when the lender is doing their evaluation slash appraisals, we have no contact, obviously, with the appraiser. We submit everything to the lender, so we have no bias on that as well.
And from our last market tour, Mitch, also got to hear Zach talk about also having our suppliers walk the properties with us. So they're kind of crafting a plan for what each unit would need down to the measurement level, where they'll pre-assemble kits in the warehouse to come in and be able to execute the remodel in a very efficient way. Casey, do you have like an average amount of days for converting a classic into a finished unit? What does that look like typically?
Yeah, we aim for the unit to not be down for more than 45 days. So from the time that the tenant moves out to the time that we have a new tenant move in, it's about 45 days.
Awesome. Matt asked a good question about what's our internal GC profit margins, and do we have those pushed to a property level? What does that look like?
Yeah, and I see that question. So internal GC profit margins, I think from my perspective and being independent of Rise 48 construction, we pay a 7.5% CM fee to Rise 48 construction, and that's pretty much industry standard. It might fluctuate 25 bips here or there, but that's what we pay to Rise 48 construction, and that's paid by the lender. That's not paid, from the property. And from a PM perspective, it is a 3% property management fee that is incurred at all the properties that are paid to Rise 48 communities / Rise 48 residential, and that is an expense incurred at the property level.
That's great. Matt, if you have a follow-up there, just let us know. Casey, thanks for answering the calculation for debt yield. Matt also asked, do we walk every unit and compare with rent roll? The answer is yes. And then Chris asked, do you believe 2026 will offer a strong disposition outlook on the current assets under management? Do we have any forecasting of when we would start disposing of some of our assets?
Yeah, let me walk this back. With multifamily housing and the real estate market as a whole, the way the rate curve has been working is industrial and commercial and kind of like that manufactured is the first to kind of see an effect on the forward side. Multifamily housing is a little bit slower to react. So kind of in the back half of 2026, we anticipate looking at dispositions. We're evaluating them currently right now, obviously. And if we can pull the trigger, we will. But really kind of we're looking realistically for our first couple dispositions in the back half of 2026, going into 2027, just because we don't know what that rate environment is going to do. Obviously, with our current administration and rate policy, there could be a complete overhaul, which could completely blow up the market. And if rates fall that far, then it's going to be guns blazing. Everybody's going to be selling. So just depends on what that looks like. But realistically, kind of back half of 26, first half of 27.
Awesome. Mitch, Kathleen, Matt, JC, Murray, Walter, if there's any other questions, this is kind of the final call for questions, or Mitch or Matt, if you need any clarifications on the one you put in, we're happy to do that.
Yeah, just one last question for Casey, and thank you for all the time here. I guess, what do you worry about most when underwriting these deals? Is there anything that you see as like the biggest risk?
That's a really good question. And honestly, for me, it's more of like, honestly, exit rate expansion, like market liquidity, like especially in the last couple of years, like if that continues for the next couple of years, what does that look like and how do we mitigate that risk to us? overestimating rent growth is a big one just because of the supply, right? So we try to stay very realistic. We've had a lot of, investors or fund managers come back and ask like, well, why are you only modeling this, this, and this when we think it's going to be this? Well, we don't want to be caught with our shorts down, essentially. So we want to make sure to provide a good baseline. And then the third biggest thing for us, specifically at Rise 48, is payroll and insurance. Those are two really big things, and we don't have much control over insurance, but we have a really good handle on payroll and how we operate our units effectively. And we have a benchmark across the different MSAs of how we operate.
Awesome. Thank you.
Yep.
Well, with that, guys, we're going to conclude our session. Casey, thank you so much for jumping on. Excellent job. Mitch, Matt, and everyone else who asked questions, we really appreciate it. As always, feel free to reach out to me, Nick, at rise48equity.com, or Jeremy. We're happy to assist. And looking forward to next month's session on goal setting. It's going to be a banger, so come. And with that, we'll end for today. So thank you guys so much.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.